So in this video, I'm going to discuss two questions. The first one is exercise 12.3. The second one is 12.4. We are looking at the example how to calculate allowance for doubtful debt using different techniques, including how to record the journal entries for the bad debt as well as reversal of bad debts. Let me read these questions. On June 20th, based on past experience, you come up with estimation of 1% of the year net credit sale of 330,000 will not be collected. So the amounts of allowance for doubtful debt will be 1% multiplied by 330,000. Okay, that is on June 30th. Later on October 5th, that is after a concerted effort, after a great effort to collect the money, you decided that amount of 550 from McGrath will not be collected and should be written off as bad debt. So this one we're going to record as bad debt. So this will be our expense. However, okay, on 15 November, McGrath unexpectedly paid 240,000 of his bad debt or of his debt that we have written off on 5th October. So you are required to record the transaction in journal form. What are the journal entries? And determine what is the balance of allowance for doubtful debt and bad debt recovered. Where are these accounts shown on your financial statement? Okay. This PowerPoint is available on your Moodle under week 5. Okay, let us go one by one. How to calculate allowance for doubtful debt as of 30th June? The amount will be 1% multiplied by 330,000. Okay, so we are using the allowance method. So the journal entry should be debit bad debt expense. This is your income statement item. Please go to your income statement item by 3300, and you're going to credit allowance for doubtful debt. This is your contra account receivable. So this will reduce your account receivable. So this will go to your balance sheet. Okay, by amount of 3300. So this is for the first one. Okay, debit bad debt credit allowance for doubtful debt 3300. Okay. Later on, you want to write off. This is your accounts. Let me just draw these accounts. This is your allowance for doubtful debt. Now we have 3300. Okay. You provide 3300 as your doubtful debt. So when we confirm that we're not able to collect 550 from McGrath, the transaction, we're going to debit our bad debt expense accounts. We're going to debit our allowance for doubtful debts. We're going to debit our allowance for doubtful debt by 550. So our allowance for doubtful debt will reduce to 2850, I think, 2850. 2850. So the journal entry will be debit allowance for doubtful debt, and you are going to credit your account receivable. Your account receivable before this, maybe you have 10,000. Now you're going to write off 550 from your account receivable. Okay, this is credit account receivable of McGrath by 550. Later on, there is on 15 November, McGrath came back and unexpectedly pay $242. So this will be your bad debt recovered. You need to reinstate this amount first in the account receivable of McGrath before you make the payment. So this is the process to reinstate the account. So you're going to debit back the McGrath account by 242. So in your account receivable, before this you already minus 550. So now you add back 242. And then you're going to put it as your revenue, that is bad debt recovered. This go to your income statement. Go to your income statement by amount of 242. And then when you receive the cash, you're going to debit your cash account, increase in cash, you're going to debit your cash account, and you're going to reduce your account receivable. You're going to reduce your account receivable. Okay, we add 242 now. When we make the payment, when we receive the payment, you're going to credit your account receivable. So debit, cash at bank, credit, account receivable. So this is the process example on how we use the net credit sales method, whereby to determine the allowance for doubtful debt, we are going to use certain percentage based on the total net credit sales revenue. In this example, we provide estimation that 1% of the net credit sale will fall under doubtful debt. That is why we got 3,300 as a doubtful debt. So what we did, we debit bad debt expense. It goes onto our income statement, and then we credit allowance for doubtful debt. That will reduce. There is a contra asset account for account receivable. So your net account receivable will reduce by 3300. Later on, you realize that 550 from the allowances from the doubtful debt 330 that you have provided before, you realize that 550 will not be collected, should be written off. So in that case, you need to debit your allowance for doubtful debt by 550 and going to write off the McGrath account by 550. So McGrath account, you're going to write off by amount of 550. Unexpectedly, out of sudden, McGrath came and paid 242. You already closed the McGrath account by 550. This is what you did before this. So now you need to reinstate. You need to debit plus 242. Debit 242 in McGrath account, and that is debit McGrath account 242. This will fall under bad debt recovered. This is your revenue. And then when you receive the payment, you're going to debit your cash. Your cash will increase by 242, and then you're going to credit the account receivable. So this is for the 3 transactions. So what happened to your allowance for doubtful debt account? Originally, you have 3,300. Okay, and then we write off 550. So the balance of our allowance for doubtful debt now is 2750. So this will be your balance for allowance for doubtful debt. Okay, so your bad debt recovered will be 242. It will go into your income statement as income. This one go as your income. Okay, 2750 will go to your balance sheet. You need to show a deduction from your account receivable. This is a contra current asset account. Contra current asset account. Okay, are you okay with this? Yeah. Okay, let us move to the second example. That is another technique that is based on aging method. I did explain during the lecture that we have several methods. The most common one will be that based on the percentage of net credit sale. Another good method is based on aging, whereby you need to determine the age of the bill and come up with percentage based on the age of the bill. So in this example, on 30th June, the end of the financial year, Burnside Consulting completed an age analysis for its accounts receivable and determined that allowance for doubtful debt, okay, of 12,320 was needed in order to report account receivable at their estimated collectible amount in the balance sheet. So you are required to prepare the entry to record the bad debt expense, assuming that your allowance for doubtful debt account has already 1,940 credit balance. What does it mean? Previously, we already provided 1940, okay, as our allowance for doubtful debt. Based on aging method, we found that the balance should be 12,320. Okay, this is a credit balance, credit balance, Another example here is, what if the balance here is a debit balance? So how are we going to account for that? Okay, let me show you. For the first one, if the allowance is on credit balance, okay, mean you need to provide additional of 10,380. Let me draw the T account for every one of you. So this is your allowance for doubtful debt accounts. Allowance for doubtful debt account. You already have a balance here. Your balance brought down 1940. And then when you come up with the aging method, you found out that the balance CD, should be 12320. So you need to add the missing figure here. So this is your adjustment. This is your adjustment for allowance for doubtful debt. Allowance for doubtful debt. So the difference is 10,380. So that will be your bad debt expense. That will be your bad debt expense. That is increased in allowance for doubtful debt by 10,380. So debit bad debt expense and credit allowance for doubtful debt 10,380. So that is the difference between the net sales method, net credit sale method, and aging method. Aging method will give you your balance CD, balance carried down, your closing balance for allowance for doubtful debt. Okay. So how do I get 10,380? That is 12,320 minus the balance, the existing balance of 1940. Okay. In the second example here, okay, assuming that the allowance for doubtful debt has a debit balance of 820, debit balance of 820. So this is your accounts here. You have a debit balance of 820. What does it mean? It means that you have here allowance for doubtful debt accounts. Debit balance means the balance BD is 820. Your balance CD carried down for this is 12320. So the difference here, the missing figure here should be 13140. 13. This is your bad debt. So how to account this? Debit bad debt expense by 13140 and credit allowance for doubtful debt 13140. So that is the increase in allowance for doubtful debt. Increase increase in allowance for doubtful debt. Okay, by 13140. So please be careful with a debit balance or credit balance. Okay, and then you are required to prepare. Okay, let me explain again about this. Yeah, as I mentioned before this, that we have allowance for doubtful debt. Allowance for doubtful debt. Okay, this is your accounts. Normally, it will have the normal balance should be the credit balance. So this is your AFDD. But in this example, you have a debit balance. So debit balance will be here. That balance BD 820. And when you do your aging method, you found that your balance CD, the new balance CD, should be 12320. So there is an increase in allowance for doubtful debt by 13140. So how to account for this? You're going to debit bad debt expense, increase in bad debt expense, and also increase in allowance for doubtful debt. Debit bad debt 13140, credit allowance for doubtful debt 13140. So that is the transaction for this. Okay, and C, prepare the journal entry to write off an account receivable, okay, for Smith 781. How to write off Smith 781 is similar what we did before. We're going to debit our allowance for doubtful debt by 781, yeah, 781, and credit account receivable, reduce our account receivable by 781. So this is how we're going to do that. That is on 30th June. Yeah, debit allowance for doubtful debt. So you're going to reduce your allowance for doubtful debt by 781 and reduce your account receivable. So this is your allowance for doubtful debt. Another one is your account receivable. Account receivable. We're going to reduce it by 781. Credit 781. So that is the process to write off the accounts. And finally, you assume that before the entry recorded in requirement C above, the net amount of account receivable was 99,000. What will be the net amount of account receivable after recording the write-off? Okay, so how to determine whether you should debit or credit account receivable? Always remember that account receivable is asset account. Account receivable is assets account. Account receivable is asset account. So any increase in the receivable, you're going to debit. Any decrease in account receivable, you're going to credit. When we write off bad debts, mean we are reducing our account receivable. That's why 781, you're going to credit our account receivable because the bad debt write off will reduce our account receivable. Okay. Bad debt will reduce our account receivable because we cannot collect the money. Account receivable is the amount of money that you expect to receive in the near future. If something happened to your customer, your account receivable amount will reduce. Okay, you cannot collect the money, so the amount that you're going to receive reduce. That's why in this example, I credit your account receivable accounts. Credit the account receivable account. Okay, so in this example, what if your account receivable, the net amount of account receivable is 99,000 before we make the adjustment? So what will be the net amount receivable after recording the write-off? So the answer will be the net account receivable are still 99,000 because 781 was subtracted from AR and allowances. Okay, let me say this. Yeah, before this, before, yeah, before you have account receivable 99,000. Okay, let me, what is the allowance for doubtful debt is 12320. 12320. So this is your allowance for doubtful debt. Example. Minus allowance for doubtful debt 12320. Okay, this is example, yeah. This is example. So your net amount, net account receivable is 99,000. Can you follow me? This is before, yeah? This is before. So what is your account receivable balance? It should be 99,000 plus 12320. That gives you 111,320. Okay. If you perform this process, you write off your bad debts, yeah, you write off your bad debts, your account receivable here will not be 11320. It's going to be 11320 minus 781, minus 781, maybe minus 781. Okay, that is the new balance will be 110,539. What happened to your AFDD here? AFDD here, you're going to minus by 781 as well. Minus, sorry, 12320 minus 781. So this gives you 11,539. Your total net debtors will be 9900. So 99,000. Another zero here. So net receivable are still 99,000 because both AR and allowances for doubtful debt are deducted by 781. So but the net amount will still be the same. Still be the same in this example, yeah. Okay, this is just an example. This usually the balance here is the balance before that. Yeah, you can see if you use a different number, it will give you the same amount, that is 88,680. Okay, I'm using the gross amount of debt. This example use a gross amount. The net amount of account receivable is 99,000, but it's still the same. Yeah, can you see here? Still the same.